Kia ora, good evening. Well, stock markets around the world have plunged into the red tonight as fears grow of a global recession. It comes as Wall Street enters what's known as a bear market, a drop of more than 20% since a peak in January. Investors are selling off stock ahead of a predicted interest rate hike by the US Federal Reserve. Rising inflation, the war in Ukraine and a slowdown in China's economy are also contributing factors. Well, joining me now is Brad Olson, Principal Economist at Infometrics. Okay, Brad, this all started in the US. What is freaking out Wall Street?
Well, really, it's inflation and just how high and persistent it's currently coming through. The markets had been looking at some of the inflationary indicators over the last month, thinking perhaps the worst was behind us, perhaps the peak had come through. But more recent inflation data out over the last week in the US has very much prompted a view that there is still worse to come. Inflation is very high, and that is going to prompt interest rates to continue to rise even faster. Expectations now that the US Federal Reserve might have to increase interest rates by 75 basis points, the first such large increase since the 1990s, to try and get that inflation under control as soon as possible. So very much a reaction there to very high inflation, markets not feeling like there's a huge amount of good news coming forward and starting to see a bit of a sell-off.
Yeah, so it's sort of about confidence in the economy, in the US economy. Are investors predicting a recession?
There's certainly a big expectation that a recession of some kind is coming. Just because of that removal of such cheap, easy money, there's a feeling that there are worse things to come. That increase in interest rates will be reducing just how much free and cheap, easy money there is out in the economy. That's going to see households start to spend less, and the feeling is that with that less spending going into the economy, there's going to be less general economic activity. All of that comes at a time, again, when we know that inflation does need to get under control. It's the worst in the US since the 1980s. The pressure very much on for how the US Federal Reserve and markets and central banks around the world can remove the stimulus put in place throughout COVID-19, but also try and engineer what people talk about as a soft landing. You want to be able to try and bring back economic activity so that inflation slows down, but perhaps not so much that you have that hard crash landing of a big recession. All bets are off at the moment, though. Given how high inflation has gone, there's a feeling that central banks, including the Federal Reserve, need to go big to try and get inflation under control.
Yeah, and have we seen that sentiment from the US spreading globally today, Brad?
Yeah, we have. I mean, just about every market around the world is feeling the pain. Even here in New Zealand, markets down, I think, 2.6% at the end of the day. That blood being very much spilt across the floor. It comes at a time, remember, after we've seen stock markets go quite berserk, really, over the last 2 years or so with interest rates so low. A pullback was always expected, but given just how sharp of a correction we're starting to see, expectations very much are that if the US starts to feel that bite from inflation, but also the bite from harder and faster interest rate increases, the rest of the world will follow in terms of just how much possible global economic slowdown might well be on the cards.
Well, who is this going to hurt here, Brad? I mean, a lot of Kiwis will have exposure to those stock markets through KiwiSaver, for example.
Yeah, absolutely. KiwiSaver balances aren't looking pretty at the moment, nor are your Sharesies or Hatch accounts if you've started to put some money into the stock market in recent times. What we know is particularly some of those big, heavy tech stocks are starting to be hit harder, just because if the economy starts to dip, feelings are that people won't be spending quite as much on big luxury electronic items and similar. Here in New Zealand, some of our sort of more protective stocks, particularly energy stocks, are a bit more of a buffer, which is why you haven't seen our stock market hit quite as hard. But certainly a feeling that at the moment, again, those stock market prices aren't looking good, and people's investments won't be in a very good position.
And just finally, Brad, it's people who are hit hardest, I suppose, by big swings in the stock market. So those people nearing retirement, isn't it?
Yeah, and I mean, by this stage, you'd expect that most people nearing retirement age will have moved some of their investments into a more conservative fund, so they're not as exposed to the likes of this bear market at the moment. But things are still being hit, and there's still an expectation that there's not only been a lot of pain so far, but there's still more pain to come.
Well, thank you so much for joining us and getting to the bottom of some of those factors, Brad Olson.